Now coming back to what is called as, we saw all this gross profit and everything out here. Are the shareholders interested in this? Yes. Are other stakeholders invested in this? Yes. Shareholders are interested in one more aspect also. They are also interested in what is called as the dividend policy. Now, what is the dividend policy? Dividend is the earnings what they are getting out of the profit. The profits when it get distributed, the profits when it get distributed, and what they get, the profit what the equity holder gets is what we call it as the dividend out. The first and foremost, why they are interested in knowing is they want to know what is the dividend yield. Now, what is this dividend yield out there? What is yield? Now, let us look at the policy. First of all, let us understand what is dividend. A company says they are paying 300% dividend. Let us take the case of Infosys itself. The share price of Infosys, the market price of Infosys is about 1500, around 1500, 1545 or something. That is what I said in the last class, around 1500. The company says and you buy the share at 1500 in the market. Please note, you buy the share at 1500 in the market. I sell it at 1500, you buy it at 1500 in the market. Once you buy it, the company declares a 300% dividend. Now 300% of what? That is what is interested. 300% of what is called as the face value of the share. What is the face value? The value at which the shares are denominated. Now, what is the denominated? I said I have a capital of 10 lakhs. This 10 lakhs is divided into 1 lakh shares of 10 rupees each. So, that makes it 10 lakhs. Now, this 10 rupees is what we call as the face value. This 10 rupees is what I call it as the shares are denominated. Right? Now, this 10 rupee share can sell at something. For example, in the case of Infosys, I would say the Infosys share, the face value of the Infosys share is 5 rupees, if I am not wrong. 5 rupees is the face value of the share, whatever is the number of shares they have, etc. Now, the company says I am declaring a 300% dividend. That means 300% of 5 rupees, that means only 15 rupees. 300% of not 300% of 1500. You have bought it at 1500. The company has it at face value of $5. So 5 rupees. So they will give you 300% of 5 rupees, that is 15 rupees out. Now what have you bought at where? Bought it at? I have bought it at 1500 rupees from the market. Now for a 1500 rupees, if I am getting a 15 rupee dividend, I do not know what is the dividend Infosys is giving, I have just taken a rough example. Let me not misguide you on that. I do not know what is the rate, what is the dividend rate, I have just taken a roughly 300% out there. Now I will say, we will say that, now I will say, what is the yield? What is my yield? Yield means, what is my return? I have invested, how much? I have invested $1500. What is the money I have got? I have got $15. So what is my return? That is what I call it as dividend yield. 15 by what is called as the 500, that is 1 by 100 is what basically you will basically get out there, 1 by 100 out there. So I need to know, so what do? We will say always dividend per share divided by average market price. Now what is that? Because I will not take it on a single day, right? I am bought it and average market price out there. Average market price, what is the yield they are getting? You want to know only on your investment, then replace this average market price at the price at which you have purchased. Please note, that is I am, as an analyst, I will say average market price. Now you want to know the yield that you got on your investment, like what we did earlier out here. I have purchased it at $1,500, then there is no average, I have just taken my price. As an analyst, I will say average. You want to know for your price, you want to know for the money you have invested, then put in the denominator, not average, the money that you have invested, that is all. Then the last ratio what they would be interested in is what we call it as dividend payout. What is the dividend payout? What part of the profit is the company distributing as dividend? That is all. The company, the PAT or the net income, PAT or what do we call it as, or we call it as net income. What part of the PAT or net income are they giving as dividend? The numerator is just dividends. Not dividends per share, total dividends by total income out, the net income out there. That is all. So I will say, what is the payout ratio? I will say 60% is the payout ratio. That means 60% of the net income that company is distributing as dividends. 40% is the payout ratio. That means the company is distributing 40% of their net income as dividends. Now having known these aspects out there, the last set I want to move into out there, last one or two sets out there. One of the sets what we talk about is, as a stakeholder, I am also interested in the liquidity position. How liquid is that company? Is the company's liquidity position? For example, it should not be like a company, as I said, has lot of profits, lot of assets, but all assets are in the long term. To meet the tomorrow's expenditure, that is to meet the salary expenditures of my staff at the end of this month, I do not have cash, but I have lot of assets. So what happens? You don't have liquidity, that is you do not have money to meet the immediate requirements out there. So how do we do that? Now when we classify assets or liabilities, we always classify it as long term or short term. Now what are long term? All your fixed assets, that is your land, building, plant and machinery, etc., etc. What is your short term assets? Any receivables, the bank balance, etc., etc., etc. That is the asset which can change its position within almost every day in a short term, etc., etc., etc. Land, building, it will all remain for a long term, they are all long term assets. So in terms of liabilities, what do you call it as? You say long term loan. What is short term? The creditors to whom I have to pay. Any outstanding expenditure I have, all these are short term. Now organizations always meet these short term obligations from what is called as the short term assets. I receive money on the sales, I will take that and pay the fellow to whom I have to pay for the purchase of raw material. That is, I have what is called as the for example, today let us say 20th of January, I have purchased raw material on a 30-day credit. That means I have to pay the fellow on the 19th of February. I take 5 days to manufacture. I manufacture on 25th, I sell on the 25th again on a 30-day credit. That means I will receive money on the 24th of February. Now 19th I have to pay, 24th is what I will receive, then I am short of money for 5 days. Now that difference is what we call it as the working capital requirement. That is, for 5 days I need to borrow this money, because for example, imagine I have to pay 1 lakh. I will receive 1.3 lakhs on 24th. So on 19th of February I will borrow 1 lakh for 5 days. On 23rd, 25th, 4th of February, when I receive that 1.3 lakhs, I will repay that 1 lakh, keep the other 30,000 and then keep on doing it. So now imagine a business which is continuously selling and continuously borrowing, continuously selling and continuously purchasing, I am sorry, continuously purchasing and continuously selling. Every day there is a purchase, every day there is a sale, all 30-day credit. That means every day you are going to get some money and every day you will have to pay some money. So the money what I am getting, I will use it, the money what I am getting on a sale which I made 30 days prior, I will use it for settling the purchase which I made 30 days prior out there. So it will just keep moving like this out. So what is happening? All my short term liability, I am meeting with my short term, what is called as the assets out there. And the short term assets are always called as current assets. And these are all called as what is called as current liabilities. Current, immediate. Current asset, immediate, the asset can change, changing every day. Current liability, immediate. Usually textbook will tell you any liability which is due within a year is all current liability. Any asset which is basically, what do you call it as, any asset which keeps changing the position within a year are all called as current asset. So what do? We look at the liquidity, whether your short term assets are enough to pay off your short term liabilities. So what we say, we do what is called as my current ratio. That is nothing but my current assets divided by my current liability. This will tell me, sir, what should be the number? Textbook will say current assets should be twice the current liability. Well, that again changes with industry to industry, so I do not want to give you a number. So whether the current assets are sufficient enough to pay off my current liabilities, that is what I am interested in knowing. That is what will tell me my liquidity. Now, to be even more tighter in this or even more precise, the next one they call it, what they do is they say quick ratio. Now what is this quick ratio? Among all the current assets, let's list down the current assets out. Current assets, debtors, cash, bank, inventory. Inventory can be raw material, semi-finished, or that is what we call it as work in process, or we call it as finished goods. Now what do you say? Among these, which is the current asset which is very sticky? The current asset which is very sticky is inventory. When I say sticky, it is difficult to convert among these things to cash. Cash is cash. Bank I can go and withdraw. Credit debtors, sir, it is very difficult to collect. Yes, it is difficult to collect. I can do discounting. So what happens? What is discounting? Supposing I am going to get on the sale what I made 1 lakh on 24th of February, but I need money today. and I have a promissory note, that is the person from whom I have to receive the money, that person who has bought the goods from me has given a promissory note that he will pay me on the 24th of February, I can go to the bank, my bank, and say discount it, keep this and then give me money out there, discount it. So they will, bank will say, oh, 1 lakh you are going to receive on 24th of February, I will give you 90,000 today as of now. On 24th of February, when the whatever the person to whom you have sold, he pays 1 lakh, the bank will take that 1 lakh out there. Now bank is giving only 90. Yes, that 90,000 is worth much more for me than 1 lakh on February 24th. I make that decision. So what have I done? I have discounted all my receivables. I can sell my receivables. I can do what is called as a thing called factoring out there. So all these are relatively easier to convert to cash. Why is inventory sticky? Obviously, imagine you are an automobile manufacturer and you are manufacturing, you are in an assembly line, you are assembling cars. On 31st of March, you will have half assembled cars, a car with engine, without tires, a car with only the shell, without engine, all kinds of conditions out. Will you be able to sell those? You will never be able to sell those. It is very difficult. So what happens? They are all what we call it as sticky. Now, they will say, for example, even raw material inventory. I am an automobile assembler. I buy tires from one of the tire manufacturers. I have lot of tires. Now can I sell the tires? I can sell the tires. But if you have to buy a tire, whom will you buy? You will obviously buy it from a manufacturer directly, or than going into what is called as another automobile company and buying it from there. They will have to sell it at a discount and so on and so forth. So these become very sticky. So what is the asset? This is the asset which is easier to convert. So what is the quick ratio? Whether all the current assets minus my inventory. Normally in this case, inventory means raw material and semi-finished goods or work in process, what they call it. They may not include finished goods, but let us keep it as inventory divided by my current liabilities. Whether my quick asset, what is my quick asset? My quick asset is equal to this current asset minus quickly I can convert to cash. Whether they are sufficient to meet my current liabilities, whether the ratio is at least 1, that is what I will see. That is what we call it as a quick ratio in this case. Now next, the 2 more aspects of it. Imagine you are a supplier of raw material to the company. When you are a supplier of raw material to the company, what are you interested in? You are interested in getting your money back, if you are a supplier. So what do you want to do? I want to know that though I might say I am a supplier, I will say 30 days credit I will give you, but I do not know how long the company will take. The company might give me in 30 days, the company might take 30 days more or 40 days or 50 days or whatever it is. I want to know on an average how long does the company take to pay its creditors. On an average, how long does the company take to pay its creditors? On an average, how long does the company take to pay its creditors? On an average, how long does the company take to pay its creditors? So I will say days payable, that is the ratio what we call it as. I want to know average, what is called as, I will say my I mean in this particular case I would say my average days I take, that is what do you call it as, my average inventory utilized or average raw material utilized. First of all, I need to know average raw material utilized. Now supposing let us say during the year 2020-21, my material usage, because raw material usage is 20 lakhs. Now I want to know average raw material usage, that is per day average. What is the utilization? 20 lakhs divided by 365. What is 20 lakhs divided by 365? So, hell,
5479.
I am ignoring the decimals. 5479, that is 5479 is the average per day average usage. Per day average usage. Now, on an average, I use 5479 rupees worth of material, and in my balance sheet on 31st March 2021, I have what is called as my creditors to the extent of about 3 lakhs. That means what? This 3 lakhs of creditors is worth how many days average material utilization out there. There is 3 lakhs of creditors that is there. Normally we take average in this case also. I have taken only 31st of March 2021. We will take average. We will take the previous year's creditors, current years, and what is called as find the average. Not a problem. But I am just taking it for simplicity out here. So, this 3 lakhs is the creditors on the in the balance sheet on 31st March 2021. This 3 lakhs is equal to how many days average material usage. So, what do I do? This 3 lakhs is equal to how many days material usage. What is it? 3 lakhs divided by 5479.
54.7.
54.7. So, 55 days. So, what happens? I have to pay my creditors equal to 55 days usage. I have to pay my creditors equal to 55 days usage. Though I give 30-day credit, on an average you have 55 days payable, that is you take 55 days to pay out there on an average, because this is the average, this is what we call it as average use per day. This creditors of 3 lakhs is equal to how much? 55 days of usage. So, what happens? On an average, I take the days payable is 55 days out there. Now, as a credit provider, you are also interested in what? This is not days payable, days receivable also. Why am I interested in days receivable? Only if you collect money from the debtors, you will pay me. If you don't collect money on the sales, how will you pay me? I want to know on an average how long do you take to collect money on what do you call it as on the sales what you make. On an average how long do you take for collecting money on the sales that you make. Now cash credit sales, normally sales are always credit. So I want to know first thing average sales per day. Supposing the sales for the year 2021, the sales for the year 2021 is 35 lakhs. What is my average sales per day? So, hell
9589.
9589. I am ignoring the decimals. That is the average sales per day is 9,589 rupees out there. Now I say my debitors on the asset side of the balance sheet is about 7 lakhs. This 7 lakhs is equal to how many days sales? This 7 lakhs is equal to how many days sales? I would say my days receivable will be 7 lakhs divided by 9589, that is approximately, even here let me make it approximately 70?
73 days.
73 days. That means this debtors that is there on the balance sheet, I am going to use a different color, the debtors that is there on the balance sheet, this 7 lakhs is equal to 73 days sales. I take 73 days to collect and I take 55 days to pay. So what does it mean? Your collection is neither efficient though you are selling on 30-day credit. Your payment obviously is also not on what do you call it, efficient, though you are purchasing on 30-day credit. Now these are just indicators. You will have to look at comparing all these kind of things out there. You will have to look at comparing all these kind of things out there.